Welcome to Opening Bid. We are still at the World Economic Forum here in Davos, Switzerland, and there's no shortage of big bank CEOs working the promenade, thinking about how they're reinventing their business, maybe closing some deals. Not sure what they're up to, but let's see what they are up to. Morgan Stanley CEO Ted Pick, good to see you.
Great to see you, Brian. Thanks so much for having me.
So the last time I talked to you, I think it was 2020, right in the middle of the pandemic. You weren't the CEO. I knew you were getting this job, Ted. You were my guy. I knew it.
You couldn't give me a ring and told me. That would have been good to know. I'm gonna talk more often with you.
But I think it speaks to something that you are known for. You're a relationship guy. You know, how has that helped Morgan Stanley through the years? How important are relationships in this age of AI? All I'm hearing about is AI replacing humans, but relationships still matter, right?
Wow. They say you're not supposed to say that's a great question because you're buying time to answer the question, but that is a great question. On culture, we talk about rigor, humility, and partnership. And if you don't have a timeline of a relationship, nobody's gonna be all that impressed. So we're talking about some of the folks you've interviewed. If you haven't known them for years and gone through thick and thin, you deliver product. There's rigor. You're on time. You worry about the little detail. You may be off. You get a question wrong. You give it the advice is not quite right, but you're correct and you're focused on that client over time. And then for us, the humility, part of the reason the partnership works and the relationship with clients work is we are unafraid to talk about our histories. You know, we were hours away from perdition, but then we, thanks to Mr. Gorman, 15 years. I mean, that's a long time, transformed. And when you go around the room, the tenure of the partnership, Wesley and others who are here 20, 25, 30 years, and we're gutting it because we're here for clients and the clients know what we've been through and what we can be. But we know a lot of it is just bringing it day by day. And the last piece, and this is the Morgan Stanley today, is with Dan Simkowitz and Andy Saperstein, we've got partnerships. So if you talk to me, you may be talking to me about potential merger advice. You may be talking to me about your wealth account. We may be talking about some asset allocation. We're probably not talking about a lot of other things because we raise, manage, and allocate capital. So we know what we do. We're consistent on that, but it's relationship driven. Yes, the AI is super important, brings a ton of efficiency to the cost structure and disruptive to like mainframe and that type of thing. The effectiveness of you don't need to write your notes because someone will spit it out in 20 hours of certain note debrief is taken down by 80%. We still need the human overlay. That's never going to change.
You're known as a deal maker. What's your secret sauce to closing that deal? Like, how do you do it?
Listen. I mean, some interactions are meant to turn into a transaction. Some interactions are meant to just build rapport. And clients have been around the block. Many of them have done what we do for a living. And if they feel like you're shilling, they got the antenna up. And I think the long road is the right road. Now, obviously, we're a commercial enterprise and we want to monetize the client base. But if you think about, and you've talked a lot about this, like what is the aspiration? The aspiration is for us to have a 17, 18 earnings multiple. You say, wait a second, I thought you guys were valued on price to book. Say, okay, but and you're cyclical. Like, how are you going to do that through the cycle? And the answer is there's got to be some kind of level of annuitized fee structure. Well, how do you have durability? Because clients are unpredictable. When's the M&A cycle going to kick in? Well, some of it is you have kind of the stable of clients that will transact, and there's regularity holistically amongst the client base, but not necessarily we need to print these transactions for this quarter, this half. So some folks have said, when's the M&A cycle going to kick in? You got that pipeline, and when's it going to come? The deregulation versus tariffs. So my view is it's going to come. If I knew which month, but it's going to come.
I heard that too from NASDAQ CEO, Adina Friedman. She suggested second half things unlock. But what I'm trying to figure out,
I'm with her on that.
How does it unlock? What's the speed? Do we get a rush of deals or a rush of M&A? Like, what does it look like from your perch?
It's an interesting question because these things never go as you predict quite. I do think, let's take sort of the metaphor of Davos itself, is some of the articulation of U.S. exceptionalism and the positive juju around kind of sort of more of a brawny kind of a American domestic and foreign policy and business interaction has actually I think jump-started some of the European conversations around public-private, big ideas. And I think that analog can be taken to sort of company dynamics. If there's a big print in a sector that is about to be deregulated or a disruptor, because as you know, the corporate sector is healthy. The balance sheets are pretty heavy with cash, and capital structures are pretty sound. Others are going to follow. And I think part of what's changed versus previous, as you've talked about, Brian, previous M&A cycles is I think there's something like 1,900 private companies with ag value of $1 billion or more, and the average duration in the portcos are 5-6 years. I mean, you have to feed the beast. And so these are great companies, but at some point they should be public companies. I think Adina's right. Some of those will go the public track. There's a private-public solution, but they're going to want to come. So if you're a strategic guy and you've been looking at that, and now you have a better view on interest rates, kind of in the mid-4s, so the 0-0's passed, and a better sense that interest rates are in a range, and you see all this global interaction, say, oh, but there's global uncertainty. I think it's actually a call to action. Things are going to happen. So I need to act. I'm a sponsor. I'm raising capital. I want to get going on my new ideas. I need to harvest some of the portfolio. I'm a strategic. I need to either get bigger, smaller, purify supply chains. I need to act. So if you ask me the when, I don't know if it's this quarter, next quarter, then the following quarter. But on the if, are we going to go from below trend line to trend line even higher on a 6,000 S&P? Yes, it's coming.
Is the big deal out there to be had under the Trump administration? I bring this up because the past, let's go 2 years, that big deal hasn't happened. I think Tapestry and Michael Kors, that deal didn't happen, got shot down. And there were many others like it. Does this administration enact or unlock that big headline-making deal, like two companies joining forces?
Well, I think the regulatory regime is going to be balanced. I don't think there's going to be some kind of unfettered unleashing of anti-competitive dynamics of company A and company B suddenly owning a market space. But I think some of the kind of unpredictability and some of the sort of element of administrative state is going to come back into line. And I think net, of course, the deregulatory wave is going to be beneficial to energy companies, financial companies, retailers. So I think there will be some M&A activity. I mean, part of the reason it's going to feel big to both of us is because the last time we saw a merger wave, the S&P was a couple thousand points lower. So the numbers are going to feel bigger because the notionals are bigger.
You're speaking right now, Ted, to really millions of retail investors that are sitting on a lot of gains in their portfolio. What do you tell them, or what would you tell them about stock valuations at these levels? Do they feel expensive to you?
Well, it's an interesting question because it's hard not to argue that 6,000 S&P on a straight, sort of ERP to bonds, i.e. equity risk premium, are pretty expensive. Historically, you know this stuff better than I do even.
No, I don't.
Well, you do.
You do.
And our guys, Mike Wilson and Lisa Shao and others, they spend the sort of Byron, he's superb, as is Lisa, and the old Byron Wien model of sort of comparing stocks to bonds. On an index level, it looks pretty full. I guess what I would say is, but you want to look below the index because there's so much querying of the top 7 tech names. They have a bunch of market cap. By the way, these companies are truly great companies generating a ton of cash flow. So that's not to say that they are themselves necessarily expensive. Looking at the rest of the S&P, less focused on the aggregate index. What sectors am I interested in where I've been underweight for the last 5 to 10 years? They've been out of favor. How do I feel about energy transition? How do I feel about financial services deregulation? How do I feel about certain retailers that have some interesting ways of looking at the supply chain and the customer base? And those companies, the best of those companies, don't necessarily suggest a unreasonable valuation. So I do think we're going to go from sort of index mentality. The index is always what we first look at, and I wouldn't be surprised the index is at this level or even lower at some point. I wouldn't be surprised, by the way, if it was somewhat higher because the earnings look pretty good in aggregate. And again, that inures to the disproportionate benefit of the big tech names. But I think looking beneath the covers over the next 12 to 18 months of specific sectors, I think that could be interesting. And keeping an eye on when it feels like it's sort of been a little bit of a blow off and not rushing in. I think it's always important. Long-term mentality.
One of the interesting things with your business, through a series of very large acquisitions, you're a major player in wealth management. How important is the generational transfer of wealth to a business like that? And what's the long run trajectory of that business looking out, I guess, 3 to 5 years?
I think it's existentially important. Existentially important. The women and men who are going to be running the portfolio of their parents or the grandparents, that transfer of wealth is obviously in the many trillions, and it is absolutely critical for the financial advisors to be able to navigate that with the next generation. So part of the sort of estate and tax planning mentality are parametric tax loss harvesting product, which, as you know, is one of the jewels of Eaton Vance that is now part of the kit. Is so important. The fact that self-directed trading through our fantastic E-Trade platform is very much in the hearts and minds of our 19 million clients. It absolutely critical that we're thinking about how we can navigate the client base from their self-directed trading through their financial advisor relationship, but then also as the client gets older and the financial advisor gets older, how much confidence do I have that Morgan Stanley has a plan for that wealth to be in a thoughtful way, transmit in a tax effective way, in a well allocated way, transmitted to the kids and the grandkids. We spend a ton of time thinking about that. I think technology can be very important in terms of building out probability sets on various rates dynamics and sector biases over the next 10, 20 years, but also some thought given to how do we want to think about financial planning for the kids, the grandkids, friends, donor advised funds, giving back. I think those are critical ingredients to the advice we give.
We have to let you go. I know you're an in-demand guy here, but we should continue this conversation at a later point.
You're super good to have me on.
Yeah, I always run out of time with you. Morgan Stanley, CEO and new chair.
Thanks, Brian. Appreciate it very much.
Appreciate
Thanks very much.
We'll talk to you soon.
Appreciate it. Thank you, sir.
All right, that's it for Yahoo Finance's opening bid.